Back in 1929, the market fell almost 90%. People who had real money in the morning had almost nothing by the time it was over. But in the middle of that wreckage, one boring old company didn't just survive, it doubled, then doubled again, and kept right on going. It grew to more than 5 times its size. It happened again in 2008, in 2020, in 2022. Every depression, every crash, something climbs while everything else falls apart. So what are they? And why does almost nobody own them? In this video, I'll show you all 6 of those assets. Some of them doubled while the market came apart. The last 2 work a different way, and that's where most people get it wrong. At the end, I will show you the year everything broke at once, stocks and bonds down together, and the one asset almost nobody owns that climbed anyway. So how does that even happen? How does anything go up while the whole market's coming down? It comes down to one thing about a crash. A crash doesn't destroy money, it just moves it from the people who panic to the people who are ready. And it doesn't move randomly. It follows almost the same path every single time. First, everything falls. Stocks, real estate, anything tied to a growing economy. That part everybody knows. But something else is happening underneath. The biggest investors on the planet, pension funds, insurance companies, entire governments. They can't just sit in cash. Inflation eats it alive, a little more every year, and they sure can't stay in stocks. That's where the bleeding is. So they move. They run toward the stuff that's scarce, the stuff people always need, the stuff that's already lived through a collapse before. There's a name for it, the flight to safety. And you can watch it happening right now. The institutions that manage whole countries' money have been net buyers of gold for 15 years straight. In 2022, 2023, and 2024, they bought more than 1,000 tons a year, the most in over half a century. That's not panic, that's positioning. The smart money doesn't wait for the crisis to arrive, it gets there first. So, let's follow it. And we start with the worst collapse in modern history. Before we get to the winners, look at the damage to get a sense of what they were climbing out of. 1929 is the one everybody knows. The market fell almost 90% top to bottom. To be exact, that was the Dow, the old index of big American companies. The S&P 500 didn't exist yet. Then 2008, the market dropped 37% in a single year. 2020 was faster than anything before it, down about 34% in a matter of weeks, the quickest fall in history. And 2022 was the strange one. The market fell again, but this time inflation came along and burned a hole in whatever was left. 4 crashes, 4 totally different reasons. One thing they all shared. If the market was all you owned, you got hurt, every single time. Now, here's what was going up while all of that fell apart. Its name was Homestake Mining, a gold company, pulling metal out of the hills of South Dakota. While the market collapsed, Homestake climbed 474%, and up in Canada, a miner called Dome ran up 558%. Read that again. The economy was ending, soup lines, shuttered banks, 1 in 4 people out of work, and these stocks grew 5- and 6-fold. This is the one that didn't just survive a depression, it doubled, then doubled again. So how? This is where the gold part matters, and it's not the reason you'd think. Quick thing first, because it trips people up. Gold and gold miners are 2 different bets. Gold is the metal, miners are the companies digging it up. And a miner comes with a kind of built-in leverage. When gold ticks up a little, a well-run miner's profit can jump a lot. Now picture the 1930s. Prices everywhere were falling. That's called deflation. It's the opposite of inflation, where money slowly gets more valuable instead of less. For most businesses, deflation is a slow death. For a gold miner back then, it was a gift. The government had fixed the price of gold, then raised it, so the money coming in was locked up higher, while everything the miner paid for, the wages, the fuel, the equipment, kept getting cheaper. High income, falling costs. That's where the profits went vertical. There's a dark footnote, and it matters. In 1933, the government made it illegal for ordinary people to own gold. You had to hand it in, so you couldn't get rich holding the metal itself. But the miners? Nobody could take those away. One warning before anyone gets excited. These stocks are wild. That same kind of miner fell roughly 80% between 2011 and 2015 in a calm market with no crisis at all. This isn't a buy it and forget it asset. It's a tool you reach for when the world is on fire. But Homestake was a freak of history. It needed a fixed gold price, a government stepping in, and a full depression to work. And you couldn't even own the metal. So that leaves a fair question. When you just want something safe in a crisis, something boring, something that actually pays you to hold it, what do you reach for? I know, nobody clicked a video like this to hear about bonds. Give me 30 seconds anyway, because the 2008 numbers are hard to believe. Stocks lost 37% that year. Long-term treasury bonds went the other way entirely. They returned almost 34%. Let me back up, because a treasury bond is simpler than it sounds. It's a loan. You hand money to the US government, it pays you interest. You get the money back later. That's the whole thing. So why did they soar? In a real panic, the biggest investors on Earth need somewhere to hide, and the safest spot they know is lending to the US government. So they all pile in at once. That stampede pushes bond prices up, and anybody already holding them gets carried up along with it. But here's the catch, and it's the most important sentence here. The exact same bonds lost 31% in 2022. Same asset, different year, opposite result. Because bonds only shield you from one kind of crisis. They're built for deflation, for the moment everyone's running scared and money's getting more valuable. When inflation is the thing burning the economy down, bonds catch fire right alongside everything else. Which leaves the obvious question. If this stuff saves you in one crash and sinks you in the next, what do you hold when inflation itself is the fire? This is where the metal comes back on its own this time. Remember, gold miners were the leverage bet, the fireworks. Gold itself is the slower cousin that doesn't do fireworks. It just holds. Crisis after crisis, it sits there and holds its ground. And in 2020, the year COVID shut down the entire world, gold gained about 25% while the market was falling apart. So why does a lump of metal hold up when paper money gets shaky? Because nobody can print more of it. No government can run off another billion ounces overnight the way it can print cash. People have treated gold as money for thousands of years, and they reach for it again every single time they stop trusting everything else. There's an honest cost to it though. Gold pays you nothing. No interest, no dividend, no rent. It just moves in price. In a calm, booming market where everything else is compounding and climbing, that lump of metal is dead weight. That's the price of the insurance. But what if something didn't have to wait? What if there were an asset that fed on the chaos itself, that made money off the panic no matter which way it broke? There is one, and it's the asset almost nobody on Earth actually owns. Go back to 2022 for a second. Stocks down, bonds down 31%. The two things sitting in nearly every portfolio on the planet fell at the same time, which almost never happens. There was nowhere to hide. Except this one strategy went up 27% that year, its best year ever recorded. It's called managed futures. And it wasn't a fluke. Back in 2008, while stocks were caving in, this same strategy climbed up 13%, up in the two exact years that flattened everything else. So what is it? Stay with me, because this one's actually worth understanding. Most investments only make you money when prices go up. Managed futures can bet on prices going down just as easily. The funds follow big trends in any direction. Stocks, bonds, currencies, oil, wheat, whatever's moving. So when markets fell hard and fast in 2022, all heading one way, this strategy didn't get caught in the fall. It climbed on the way down. Now, why does almost nobody own it? For decades, you couldn't. It lived inside hedge funds, walled off for big institutions, $1 million buy-in just to get through the door. The simple version a regular person can buy on their phone only showed up a few years ago. This is the one corner of this whole list where nobody owns it, is the flat, literal truth. One honest note before we move on. The 27% is the strategy itself at its best. The easy version you can actually buy didn't catch all of that. It ran lower. Still up in a year, almost nothing was. Just don't expect the headline number in your own account. So those four all spiked. Big, loud, dramatic moves. But here's what most people miss about surviving a crash. Spiking isn't the only way to win one. The last two assets on this list never spiked at all. They just flat refused to die. And that turns out to be the most powerful trick on the page. The companies that make the stuff you buy no matter what's happening in the world. toothpaste, soap, groceries, coffee, the boring stuff already sitting in your cabinet right now. In 2008, while the market dropped 37%, this whole sector fell only 15%. And in 2020, it didn't just hold, it finished the year up about 10%. Now here's the part that makes losing less so powerful, and this is the most important math in the whole video. Say you've got $100 and the market drops 37%. You're down to $63. Now your instinct says, okay, I just need to make that 37% back. So let's try it. Make 37% on your $63 and you land at $86. You're still down. A 37% gain didn't undo a 37% loss. Not even close. Here's why. You lost your 37% off the big number, the $100, but you're earning it back off the small one, the $63 that's left. So to actually climb from $63 back to $100, you don't need 37%. You need 59%. The hole is always deeper than it looks from the top. Staples only fell 15%, so $100 became $85, and getting whole again takes about 18%. Same trap, way shorter climb. One of those holes you're out of inside a year. The other one swallows the better part of a decade. That's why losing less is the whole game, not some consolation prize. The honest catch is that staples are dull on purpose. In a bull market, when tech's doubling every couple of years, this sector just slowly moves along. It lags behind. This is defense, not offense. Nobody gets rich on toothpaste. They just don't go broke on it either. Staples are the soft landing. But there's an even slower, even more physical version of that same idea. When the richest people on Earth start buying the same boring thing, it's worth asking what they know. Bill Gates is now the largest private owner of farmland in America, something like 275,000 acres. Not tech, not yachts, dirt. And the dirt has a track record. While the market got cut in half in 2008, farmland kept right on making money. Across the worst of it, 2007 through 2009, farmland was up nearly 30%, while stocks lost roughly half their value. The reason is almost too simple. People eat in every economy, and nobody is making new farmland. The supply is basically fixed, and the demand never stops. On top of that, farmland pays you while you wait, from the rent farmers pay to work it. Here's how a regular person actually owns a slice without buying an actual farm. It's called a REIT. Basically, a company that owns the land, trades like a stock, and passes you a cut of the rent as a dividend. The tickers are LAND and FPI. Two honest caveats. Farmland is slow and it's a pain to sell in a hurry. Your money's kind of stuck in the ground, and it's not bulletproof. Back in the 1930s Dust Bowl, farmland got absolutely hammered. So this isn't a lottery ticket, it's a steady, boring store of value. So now you've got 6 assets. The fireworks, the hedges, and the slope protectors, which leaves you one question. How do you know when to actually start reaching for them? You can't predict a crash to the day. Nobody can. But the warning lights are real, and 3 of them are worth watching. The first is the yield curve. Normally, lending your money for longer pays you more. Sometimes that flips, and short-term rates climb above long-term ones. That's called an inversion, and it has come before basically every recession. Here's the twist most people get backwards. Here's the part most people get backwards though. The recession usually doesn't hit during the inversion. It hits after the curve flips back to normal. The second is credit spreads. That's the gap between what a company pays to borrow and what the government pays. When that gap suddenly widens, it means investors are getting nervous about companies paying their debts. A jump of 0.5% or more fast is a real flag. The third is unemployment. When it starts ticking up off the lows, it's usually confirming a recession that already quietly began. By the time the job numbers turn, you're often already in it. You don't need to predict anything, you just watch. When 2 or 3 of these flash at the same time, that's your cue to make sure your protection is already in place. And knowing when only matters if you know how. So here's how to buy those assets. None of this requires being a billionaire or a hedge fund. Every single asset on this list, there's a simple version you can buy in a regular brokerage account today from your phone. The gold miners, that's GDX. Long-term treasuries trade as TLT. Gold itself, the metal, is GLD. Managed futures, the strategy that won 2022, shows up now as DBMF. Consumer staples, that's XLP. and farmland comes through LA&D or FPI. You'll bump into one piece of jargon when you go looking: expense ratio. It's just the small yearly fee the fund charges to run the thing, usually a fraction of a percent. Worth a quick glance, not worth losing sleep over. Think of all this like insurance. You don't buy fire insurance because you're sure your house will burn down. You buy it because if it does, the cost of having nothing is too high to risk. These assets work the same way. They lag in the good times. That lag is the premium you pay so that one of them is climbing when everything else is on fire. So now you know what to hold when the market breaks, but that's only half the job. Protection doesn't build your future. Click the video on screen to see a Fidelity Index Fund portfolio that's projected to pay $4,500 a month in dividends on just $40 a week.